These are incredible deals that banks are willing to fund because you have 100% of the cash flow to cover the 60% of the deal that you need to fund. Banks will do those all day long with you. We own the business itself that's worth 4 million. We have 100% seller finance that business, and we're renting back from the real estate investor. Everyone's happy. It's a great deal. Okie dokie, guys. In this video, we are going to talk finally about funding structures and how to fund the businesses that you're buying so that you effectively don't have to put any money down. Now, there are literally like unlimited ways to fund the acquisition of businesses, and I am still, coming across people and meeting people that are teaching me methods and bringing to light funding strategies that I never even thought of before and are super creative and surprising, to be frank. So ultimately, it comes down to how creative you are, but one thing that you really, really want to avoid doing is paying for 100% of the business upfront. Now, in our other videos where we've done business valuations, you might freak out because you're seeing some massive numbers. We never, ever, ever pay the entire amount upfront, and it's totally justified for the seller. It's not an expectation in the market. Paying for a business with 100% cash, even in like the crazy tech industries and whatnot, rarely, if ever, happens. And the reason for that is because these businesses, almost in 100% of cases, are still dependent on their owners, whether that is from a day-to-day operations perspective in a smaller business and service fulfillment, where the owner is actually still fulfilling the service, right through to these tech companies where the founder is just the driving force and the innovator behind it. Take Apple, for example, right? Since Steve Jobs passed away, rest in peace, Apple has stopped innovating. So whether you like it or not, that business in some capacity, even though it's like a $1 trillion company, was somewhat dependent on the business owner, Steve Jobs. So we never, ever, ever want to pay 100% upfront, because then they can just disappear the next day with all the money you give them. There may be skeletons in the closet, there may be tax liabilities, or we may just want them to do a formal transition and a formal handover. We get quite crazy with this with the businesses that we're buying. We literally keep the owners involved for 3 years post-acquisition to make sure that there's a very seamless transition, the revenue doesn't drop, and all of those beautiful things. So funding, believe it or not, is the easy part when it comes to this stuff. Finding the deal is the hard part. Now, we want to find a deal where the deal stands on its own 2 feet, the business pays off its own debt obligations, and it still has a lot of profit to spare, so that when we take it to potential funding partners, banks, investors, angel investors, high net worth individuals, friends and family, it's a no-brainer deal. They want to look at that deal and be like, there's no risk here. Why wouldn't I fund this thing? Right? That's the hard part, is finding those deals. And that's why it ultimately comes down to finding a motivated seller that's willing to part way with their business for a reasonable figure, on the basis that you're getting them out quickly and you're helping solve a big problem of theirs, as opposed to someone that just wants to get rich by selling their businesses. Don't ever buy a business from someone like that. There are so many businesses on the market, it's just not necessary, and you're going to end up shooting yourself in the foot. So if you find a business where the cash flow covers debt service, that means it's a good deal. Go ahead with it. You're not going to have a problem raising the funding. If it doesn't cover debt service, if the cash flow doesn't cover the debt service, right? If the business can't pay itself off, it's probably a deal you shouldn't be doing, and you should just walk away from it. Now, this is a high level video of the fundamentals and the conceptual side of what all of these funding strategies look like. In another video, we'll actually break down some examples and go through how we can structure some real life deals. So that'll be in a separate video. Now, the first port of call with every single deal that we look at is seller finance. It's something you've probably heard of. All of these YouTubers talk about. Cody Sanchez, Roland Frazier, Dan Pena, everyone talks about it. And the reason for that is because every single deal, I think it's something like 60% of M&A transactions in the US have some element of seller finance. Every single deal is going to need some seller finance. And that's the way it really happens in the market. So seller finance means that we pay back the seller over time. Ultimately, again, the golden goose is deals that can be done 100% seller finance. And that's very, very rare. I'm not going to sugarcoat it. These guys are going to tell you, go and find all these 100% seller finance deals. Usually the seller is a little bit crazy to do something like that. We don't want to pigeonhole ourselves to just those deals. So I'm going to show you a way where you can 100% seller finance a deal without 100% seller financing a deal, where the seller gets a whole bunch of cash up front. And that'll be super interesting. We'll get into that in a second. Second to seller financing is debt, right? Commercial debt, bank debt, friends and family. The SBA loan is something that's in the US. Debt is the holy grail because we're not giving away a percentage of our business for that debt, except for in some examples such as mezzanine. Some mezzanine debt providers take what's called an equity kicker. So they'll provide the debt to you instead of a bank because they know you can't get a loan from a bank. And then they might take 5 or 10% of that business as a additional upside for them. But so the debt, we can go to banks. In the US, we have the SBA loan, which is a 10-year loan, which is absolutely amazing because it means if you buy a business with financing that spans over 10 years, you can buy that business at a 5, even probably a 7 times EBITDA multiple, which is just absolutely insane. And you shouldn't pay that much for a business, but you can buy a business for that much and still afford to pay it off because you're slowly paying it off over 10 years, right? It's like I would pay $1 billion for a shitty little business if the terms were that I could pay the $1 billion back $1 per day, right? No problem. So ultimately what it comes down to is what the deal, the integrity and the value that the deal has and how good the deal is for you comes down to a combination of price and terms. And these terms are what we're talking about now, where you don't have to pay it all up front. You can seller finance some of it, you can bank debt some of it, but even the bank debt terms have to be good. And then you have a good deal on your hands where you're generating a profit by buying the business. Now, some other debt mechanisms include mezzanine debt, like we talked about, asset-based lending or asset-backed lending, which is you take all the assets of the business and you borrow against those. And banks are willing to do that for a business that you are acquiring. You don't have to already own the business to take the debt out on those assets. Private lenders, like we talked about, high net worth individuals, even credit cards. We're funding an acquisition at the moment on a credit card, believe it or not, and family offices. So there's all sorts of different places to go and get debt. And then the last place you want to go to is to equity, to sell equity, basically, to go to private investors, angels, those high net worth individuals, again, similar people from the debt providers, but the ones that want equity. Private equity firms, they're the most criminal ones of all. We don't deal with private equity firms at all because they just want to take the entire business. And then what we call friends, fools, and family, which is effectively friends and family members that are going to invest in the business. A couple of creative funding structures and tips, and then we're going to get really into this in our future breakdown videos. But there are some interesting things that we can do so that we don't have to pay for the entire business up front, but the seller still feels as though they're getting a good deal. Now, one is we can just do a majority purchase as opposed to 100% acquisition. Now, you don't have to buy 100% of the business to control the business. You can just buy 60% of the business. The other 40%, you can sell a founder on the idea that you are executing on a roll-up and that their business will be worth far more when they are a part of the group and we do our big exit at the end. So you can tell them, hey, retain 40%. We're going to come in and buy 60%. Your 40% will be worth way more than even 100% of your business is worth at the moment in 5 years' time. We just want you to continue running the business. These are incredible deals that banks are willing to fund because you have 100% of the cash flow to cover the 60% of the deal that you need to fund, right? So you're paying, let's say it's a $10 million deal, you're paying the seller $6 million. If you take that as a bank loan, you have a $10 million business to pay off only $6 million worth of debt. So the debt service is usually really fantastic. And you keep the owner involved, which gives the debt providers a lot of certainty and comfort in the fact that the business is going to continue to run smoothly. So that's a fantastic deal structure. Banks will do those all day long with you. The other one is the property and business buyout. So what we do is we find businesses where there is a property that makes up majority value of the business. And we tell the seller, okay, we're buying this business for $10 million. We've done the calculations. The business itself is worth $4 million and the property is worth $6 million. So we tell the seller, we're buying this business for $10 million. We're going to give you 60% upfront. The remaining 40%, we're going to seller finance over the next 5 years or 10 years. So they get their 60% upfront. In order to fund and pay that 60%, we take the property, we go and find a private real estate investor. We sell the property to them. So they pay the 60% upfront to the buyer. We've paid nothing and we pay our 40% back slowly over time. The investor owns the real estate. We own the business itself that's worth $4 million. We have 100% seller finance that business and we're renting back from the real estate investor. Everyone's happy. It's a great deal. The seller got 60% upfront. So that's just some ways that you can creatively structure these deals so that you're not breaking the bank and you're not putting down a heap of your own money or any of your own money at all. Now, just to be perfectly transparent, it is easier if you have your own money and you can. You know, these banks, ultimately, they like to see a deposit. You can do it without a deposit. We'll talk about that in another video, but they do like to see a deposit. Investors like to see that you've got skin in the game, that you are spending some money on the business. It's easier, but it's not the be all and end all. Again, another thing that all these M&A influencers say is you don't need to put any money down and it's easy to do no money down deals. In reality, it's not. It's a lot of hard work. That's why I'm bringing this to you so that you know how to navigate it and how to go about it and what to expect. But the payoff is ultimately worth it at the end of the day. So can be done with no money down. I just showed you a couple ways how. We'll get more into it in another video, but that's a really high level of how the funding works because I know you guys have been waiting for it. Please like, comment, subscribe, drop your comments down below. I would love to hear what you have to say about the content in the video. Let me know what you would like to hear about next. Thanks guys, appreciate you, peace out.